Hello listeners and welcome to Plugged In, the energy news podcast from Montel, where we bring you the latest news, issues and changes happening in the energy sector. Today we're looking at the changing shape of Europe's power purchase agreements, or PPAs for short, the long-term contracts that help renewable energy projects get built and financed. One phrase you'll hear throughout this episode is capture rates. The capture rate is the share of the wholesale power price that a renewable generator actually receives when it sells electricity. Because solar and wind produce power when conditions allow, and often at the same time as many other renewable assets, they can end up selling into an oversupplied market when prices are lower. So even if headline power prices look strong, the price a solar or wind project actually captures can be much lower. And that matters, because falling capture rates, more frequent negative prices, and a more volatile market have all made PPA negotiations more complicated. After a long period of growth, the market has entered a mature phase, one where risk, flexibility, and deal structure matter more than ever. To help us set the scene, I'm joined by Italy correspondent Alina Trabattoni.
Hi, Richard. Great to be on the podcast.
Today we're talking about PPAs, power purchase agreements. The market had a fairly rough 2025, I think it's fair to say. Do you think it's in structural decline or just going through a tough patch here?
Well, Richard, it's actually neither a collapse nor business as usual phase. What we're seeing, at least according to many of the analysts and experts I speak to, is that the market's maturing after a very long growth phase, because for years the conditions were almost ideal. There was local curtailment, plenty of off-takers, nice strong price signals, but it appears that that era is over. Renewables have flooded certain markets. Capture rates have dropped sharply. That's always bad. Negative prices have become routine in places like Germany, and the result has been a real structural dip in PPA volumes in 2025, particularly in southern European solar and northern European wind markets. And that's been the first such structural fall in a decade. But in actual fact, the underlying demand for long-term clean energy contracts hasn't gone away. What's actually changed is the risk profile. Buyers and sellers are having to get much more sophisticated about how they price and how they share that risk. I'm researching, for example, a very interesting new product which is expected to grow in terms of development in Europe at the moment. They're called nighttime renewable PPAs, and they're just some of the new products developing, and that's definitely a sign of a maturing market, not of a dying one.
You can expect some kind of, a cyclical element to this as well. And it sounds like there's a lot of consolidation going on as well as increased complexity. But, if we look at the current geopolitical situation, particularly the crisis in the Gulf, Alina, how is that affecting PPA deals?
Well, obviously, the geopolitics can and is changing from hour to hour and day to day, as we've seen in past days. But the picture is actually much more nuanced than it may appear. You've got rising gas prices and then they drop quickly. But we've had rising gas prices for a prolonged period and forward curve volatility that have pushed up PPA fair values significantly at the short end of the curve. And that should, in theory, make renewable contracts more attractive relative to fossil alternatives. But on the other hand, when you've got a sharp spike that's driven by geopolitical risk, buyers tend to pause. That's because there's uncertainty about whether this is a temporary shock or a sustained shift. And there's also a timing mismatch. These shocks play out over days or weeks, while a PPA transaction typically takes 6 to 9 months to close. And until that question's answered, many corporate off-takers would prefer to wait than lock in a long-term contract at a price that may look very different in 6 months. So paradoxically, even absurdly, as one analyst I spoke to recently said, a more volatile gas market can actually slow PPA transaction volumes in the short term, even though it improves the underlying economics.
No, very interesting, Alina. And where would you say in Europe, where are the bright spots for PPAs and where is the market actually struggling?
Well, at the moment, Italy is doing relatively well. Poland has been performing very well. As Spain obviously remains the largest market in Europe by in terms of volume, consistently delivering multi-gigawatt deal flows, despite all the challenges that exist around solar capture rates, which we're all very aware of. And the markets that are struggling are those with high solar saturation and weak industrial demand, and also the ones with attractive auction alternatives that simply outcompete the merchant PPA route. Germany's a good example. The auction mechanism has been more attractive than merchant contracting for many developers, so PPA liquidity there has thinned. But the theme emerging strongly now is hybrid structures. So we're talking solar paired with storage, wind and battery co-location, multi-technology portfolios. That's where the growth is. That's where the real growth is, because it addresses the core problem, which is buyers want firm, shaped power, not a pure pay-as-produced solar profile.
That fascinating, Alina. Thank you very much indeed for your insights and your explanations here.
Thank you.
Alina paints a picture of a market that isn't disappearing, but becoming more sophisticated, with buyers and sellers having to think much more carefully about pricing, volatility, and how risk is shared. So what does that mean for the companies trying to get these deals done? To unpack that, I'm joined by Luca Pedretti, COO and co-founder of Pexapark. Welcome back to the podcast, Luca.
Great, Richard. Yeah, indeed. It's been a while.
I hope you're well. We're here to talk about the PPA market. How would you characterize the current state of play, Luca?
It's gotten a bit more opportunistic and value-driven. When we look back doing this for more than 10 years, it has been a huge growth phase just in the PPA space. And now we're in a completely different market regime. Markets have been inundated with renewables, and this had an impact on the PPA market.
In what way? What can you describe? I mean, I've used the phrase the 3 C's, so congestion, cannibalization, and curtailment. Is that also?
Yeah, they were all very low 10 years ago. And this is when the PPA wave really started in the Nordics and in Poland, and then it spread all over Europe. And there were plenty of off-takers, there was plenty of liquidity, and there was low Cs, low cannibalization, low curtailment, which was a perfect environment for PPAs. And now it's a bit harder. That's why when we look at the last year in 2025, we had a first real structural reduction in the PPA market. It was like 15 gigawatts overall, which was 20% less than the year before. And what we saw is in certain markets, like in Germany, solar capture rate went from the high 90s to the low 50s in percentage of baseload. Then we have negative prices exploding, a big topic on your podcast, in our price intelligence. You have 5 to 6% on average of all hours in Europe being negative. And if you're a solar producer in Germany, for example, 25% of your hours are in negative price territory. And of course, this has a large impact on your contracting.
This trend we saw in 2025 will continue, Luca?
Yeah, I mean, overall, I think we do see also some market saturation. So we don't have demand growth. That's one big thing. But there is just a finite demand for solar profiles at some point. And that's why we see trends, and we'll surely talk about it for co-location or standalone battery offtakes. But what is also important to say, the PPA market is a cyclical beast. A lot of factors have to come to play. So prices have to be sufficiently high that everyone is happy. So you have to meet an investment thresholds. The auction has to be lower or less attractive. There has to be an industrial there. So a lot of things have to come together. So we think the market has become very mature, very professional, and we would expect something much more cyclical, like gas turbine investments. You have years with lots of investments, and then you have years where there are not so many deals.
So we could be in a lean year this year as well then, Luca, is that what you're saying?
Yeah, but I mean, still it's very large. So we're talking 15 gigawatts. When you look at the euros underlying those investments, that's huge. And the PPA market historically has been just 1/3 or 1/5 of around those figures of the overall investment market because you're in competition with the auctions. So I think this market will be here. It's all over Europe. We see it in Poland, you see it in Italy, you see it in Spain. And you know what? There's so much negative press because we're focused on those temporary issues due to high renewables, which will be solved again by the system. But Spain still does 3.5 gigawatts of PPAs and mostly solar. So despite all the challenges, the market is there, the market is moving, and people are adjusting. And the biggest theme over the last 12, 18 months have been how to deal with negative prices. And there are huge price differences between PPAs that take price risk on the negative side or not, which shows it's just another way of signaling this is the value of flexibility. And that's why we have this boom. When you look at the overall clean energy offtake market, it's gotten much bigger. Why? Because we have all those batteries. We have battery offtake agreements, which we call now FPAs. Has been a bit in the industry discussion. What shall we term this? And I think we have come to this conclusion. And what we call FPAs are purchase agreements from storage BESS units that take price risk. So not an optimizer agreement. That would be more like a route to market, which is 1 year and you optimize on all the possible markets. An FPA is like a floor, a swap, a toll, 5 years, 3 years, 7 years, something which enables leverage and very similar in this way to a long-term PPA.
So what does the F stand for?
Flexibility.
Flexibility, a flexible power agreement.
Flexible purchase agreement. So a flexibility purchase agreement. Sorry,
Okay.
FPA and PPA. Correct.
Yeah, okay. We got that in the alphabet soup again. But yeah, if I can turn the question back to you then, Luca, in a sense, like how do you deal with negative prices? This is one way then, with those flexibility options, so co-location with batteries, or just single, just purely batteries.
Yeah, on a single asset basis, if you cannot add a battery, which you can add for multiple reasons, not just for the negative price risk. If it is on a single asset basis, there's two ways you can mitigate it contractually. So you agree with the buyer on how to share the risk, or you agree to take the full risk and you get a huge price increase. But then you need to think of fundamentally, will this negative price risk stay? Will it get worse? How will it be in 3 years? And then you need to look at fundamentally how the market develops. And what we clearly see is we're not through the doldrums. I mean, there's still 2-3 years where we clearly see there's a flexibility gap, massive, which means those capture rates, those negative prices, we will continue to see them. But at some point, those gigawatts of batteries, demand side flexibility will have an impact and those negative prices will vanish again.
How far are we away from that? I'm asking you to get your crystal ball out here, Luca, but yeah.
My crystal ball, it's always wrong, my crystal ball, so I don't trust it. What we definitely see is that also the way market participants are pricing and those price takers, they say something. I mean, if you have to price and take those risks, you will be cautious. So over the next 2-3 years, we're not expecting a relief of pressure in the market. So when we just look at the storage space, it can't be built fast enough. I mean, on the FPA side, so like tolls and floors, we're expecting more than 10 gigs this year. But when you look at the overall system, how big it is in terms of peak demand, there's still way to go.
Mm-hmm. I mean, I think we've absolutely, as we've spoken about on this podcast and has been in the news more generally, is that there has been a massive increase in negative prices in certain markets in particular, and markets that have never seen them before as well. So that's been a key element of the picture, has it not, Luca?
Yeah, it has. But on the flip side, that's why we have this boom in battery. So the only thing, let's speak in relative manners. I mean, what you really can do right now is you can co-locate, you can build standalone BESS, and you can be opportunistic on the PPA side, looking at the cross-country, multi-technology portfolio. That's why we also see this larger and larger place on the IPP side, because on a portfolio level, you can deal with those risks very well. I think that's another trend that we were always thinking the last 10 years in deal by deal, and which was asset by asset. And most of those energy transition progress problems, we create problems by installing so much renewables, which we have to deal with again. They can be dealt with much better on a system level, on a portfolio level.
So with IPP, another bit of jargon for those listeners out there that may not be familiar with the term is independent power producers. So you're saying that they can aggregate and create a portfolio of assets rather than a single asset that makes a difference, and they have maybe cover different jurisdictions, different countries here.
Absolutely, absolutely. That's basically the development which came along with the renewables. Renewables were driven by developers and IPPs. They were the new kids on the block, and those new kids got very big. When we started 10 years, a fund was one country, 200 megawatt, that was big. And a few years, you would have said, wow, 2 gigawatts, a few countries, that's big. Now we're talking 5 to 10 gigawatts as an ambition, multi-technology, multi-country, having your own origination team, your own trading team. Because what you really can do is you take those risks, you look at them on an aggregated level, and they can smoothen and even themselves out. So if you're suffering from high price volatility, well, a battery gains in value. So the question is, what is the right mix? What is the right strategy? Of course, investment is always difficult, but there's value to be made. It's just the value pools are always shifting, but it's very clear where. You need to have more done in-house in terms of trading, optimization, analytics, and you need to be bigger. You need to spread the risks across technologies and countries. And probably the real insider thing on my side would be just don't focus just on renewables. I mean, let's broaden it a bit, because it is not just solar and wind and batteries. Maybe mix in a bit of gas, maybe mix in a bit of hydro or operating assets to create more stable revenues.
So that's a good tip for those out there, I think, there, Luca. But what a market you're describing is a market of the big boys, pretty much. So you if you're a small company wanting to get into the renewable space, you've got maybe between a portfolio of 50 to 100 megawatts. You're going to struggle.
Well, actually, that's interesting that you ask. I think actually it is the extremes. Either you become very big and diversified, or you're very niche, like you're very good at understanding the Finnish balancing mechanism and having locally built a portfolio and the trading skills that you know how to deal with it, and you open it to third parties. So I think it's both. Either you're hyper-focused and specialized in one value pool. This can be a geography or a technology or a specific skill, or you're very big to afford and playing among the big utilities.
Massive increase in complexity here that you have to deal with. I mean, 15 years ago, we didn't have Picasso, we didn't have Mari, we didn't have all these different markets or these ancillary services as well, which are obviously adding to revenue possibilities, but also to the complexity, and that you would have to have some in-house people who could understand and act on those, isn't it? So you need to, that's also an investment for these kind of players.
Yes, and this is a big bottleneck just when you look at the people side. I mean, where do you get the people from? Yeah? And the resource pool is rather limited, and also from a business model, you cannot rebuild a utility with hundreds of people. So you have to be very focused in what you do in-house and what you do externally. But those IPPs are succeeding. We call them next-gen IPPs. It's probably that there will not be 50, but maybe 20 or 25 over the next 5 to 6 years. And they're building teams of 60, 70, 80 people over time. And the other thing, what we're seeing is utilities are very much back in the game, also on the PPA side, especially on the FPA side, because this is what really goes to their strength. They already have a portfolio, they have a trading desk, they have the analysts. So they're actually, and you see it in the stats, they're showing up in bigger numbers on the off-taker side.
You mentioned the positive side, that the market is still growing or still developing at a great pace. Where are the hot spots, if you like, or the real bright spots, if you like, in the PPA market, Luca?
I would say Italy has been doing very well. Poland has been doing very well. Spain, despite the news on low capture and negative prices and the blackout, always consistently been the biggest market, multi-gigawatt. So it's still going strong. Germany, always a bit a laggard, but lots of competition there on the auction side. Wind still typically being above PPA rates. Yeah, this is a bit also UK, we would love to see much more, but I think when you look at the auction results versus PPA levels, there's just too big a gap that the free market could prevail.
Yeah. And how about AI? I mean, we talked about sort of independent power producers or companies setting up with 20 to 50 initially, growing to 70, 80. And surely AI has a role here. Could you describe how AI can help these kind of businesses?
Well, first we really hope that AI is creating new demand in Europe, which it is not yet. Definitely not comparable with, for example, the US market. Then also to apply AI successfully, you need to already have the basics in place. You need to have the IT in place, the data accessible. So it's rather something used by larger players. We see it more on the provider space, like optimizer or large utilities that have large data sets and can make use of machine learning, of large language models to help optimize, for example, a trading algorithm. Again, there you need a certain size, a certain investment to make this really valuable and practical.
And I think, do you feel that there's enough support from policymakers for both national and EU level? I think there is. We'll come on to potentially what's happening in the Middle East in a moment, Luca. But there is certainly a push to get more PPAs on the table, to get more deals done, to have more renewables in the system.
Yeah, the intention definitely is everywhere positive, trying to support, but it is a very complex undertaking just on the regulatory side. It is just getting more and more, and also for the teams to understand. It actually plays to the strength of larger player. You need to have quite an apparatus of people and systems in place to understand what regulation is actually creating. And it's even, you see regulatory opportunity because you understand so well how this auction system or the future of this auction system is going to look like, that you see value for yourself going into that. And that's a bit a different kind of business opportunity versus, oh, we see demand growth and falling technology costs. Let's invest in this.
Yeah, no, absolutely. There's a different situation entirely. And the situation in the Middle East, obviously, this is, laying bare our reliance, our dependency on fossil fuels, and what that means not just for power and energy prices, but also for industry in Europe. Is that spurring more interest in PPAs, more interest in deals? How is it having an impact? Maybe it's still too early to tell, or seeing the impact there. But
I think generally the market players were much better prepared compared to when we had the Russian war against Ukraine, and this started much earlier when they started to throttle gas supplies to Europe and prices went up. We see people much better prepared, like the way they look at risk and how they hedge. And the first impact, of course, has been on the short end. We saw gas prices going up. We saw Cal 27 going up. And now the longer it continues, the more of price risk is spreading through the curve. So we see prices going up at the further end. And this is affecting, of course, all type of energy contracts as well as PPAs. Fair values are significantly up now. We would say 20% on the short end, but this is not automatically translating into higher transaction prices because we have a spike, we have geopolitical risk, and there is a bet, is this now short-term for weeks? How big really is the damage, and is this actually overstated for obvious reasons or not? So, but right now, this risk is actually the likelihood of sustained increases in prices is increasing. But as we said, typically, if such a spike happens, people would rather take a step back from doing transactions right away.
Yeah. Taking all the complexity there. It's just adding to the mix, isn't it, of a very, very complex marketplace, and you're adding to the risks, as it were. Luca, once again, thank you very much for being a guest on the Plugged In podcast.
Thank you.
Luca's view is that this is still a big market, but one that is becoming more cyclical, more selective, and much more complex than it was a decade ago. The next question is whether the numbers point to a recovery and how batteries, hybrid structures, and more sophisticated contracts are starting to reshape the market. Joining me now is Chirag Ahuja, who's Implementation Director at Broadpeak Partners. A warm welcome to you, Chirag.
Thank you, Richard. Pleasure to be here.
We're talking all things PPAs today, and there's a lot of talk about the market slowing. What in your view, what do the numbers actually show?
Yeah, sure, absolutely. So, my opinion and what I've researched is as per Pexapark data, Europe has signed about 15 gigawatts of PPAs in 2024, which is a drop from 13 gigawatts in 2025. So it's roughly a 15% decline. But now in 2026, if you see, cumulatively, we have signed about 42 deals amounting to 3 gigawatts of power. So it does seem like a V-shaped recovery, I'd argue. So it's a pretty decent start to 2026. However, what's really interesting, Richard, is that batteries and battery-linked deals are getting very interesting, and they seem to be growing very, very fast compared to previous years. Therefore, I think that the market is not really shrinking or slowing, but it's adjusting to realities, which in my opinion is very positive and a healthy sign as it's aligning with the overall system complexity.
We'll come back to batteries in a minute, Chirag, but are there any sort of particular deals that you'd like to highlight in terms of interesting or showing some kind of a new direction or a quite novel or innovative?
Well, the overall structure is getting quite innovative. Again, it points me towards what I do on a daily basis, and that's getting this data in and out of systems for various companies. And we're seeing the contracts themselves becoming more and more complex and linked towards other variables. So the structures are becoming more complex. The deals are taking more time. On the deal specifics, I wouldn't be able to point out as such, but the overall situation is becoming a bit much more complex in my opinion.
So what's brought on this this development in batteries? Why are they suddenly so hot now? Is it to do with curtailment, cannibalization, and congestion, or is it more in a combination with negative prices? What's happening here, Chirag? If you can highlight some of the main trends and why this is happening.
Yeah, absolutely. So in 2025, Europe added about 27 gigawatts of storage, and that's a 45% growth year on year, massive. And the deal count has been 3 times higher than 2024. So demand is strong, and batteries are clearly growing fast, but there's some real constraints, right, around that. The grid connections are limited. The permits still taking time in my conversations with our business and our clients. The market rules are itself changing and becoming more complex. And financing of these new hybrid innovative structures is just taking more time because the finance people are trying to get used to these kind of deals. So the issue is, I think, not whether batteries make sense, but how fast can we actually build them with these supply chain constraints we're seeing globally, along with how we can connect that to the grid. So the technology is ready, but there's a wider, much larger ecosystem at play, which is far more complex and will take some time getting used to onboard these new systems.
These kind of new increased risks for, or are they sort of, is it that they're reshaping the risks that have always been there in a sense?
Oh, absolutely. So it's new risks which are coming on. The buyers are getting more savvy. Earlier, it was not the case, right? Prices were not so volatile. The contracts were quite straightforward. But now the buyers are able to visualize and understand the risk better. So they want better terms. They are able to drill down on the granularities of the contracts. There are more and more what if clauses flowing into these contracts. Who takes on the risk of negative prices? What happens uh, if prices go below zero? Who takes on that shape profile? Who takes care of imbalance costs? Earlier, that was so much because the volatility of the market was not as much as it is now. These were not probed into so much. But now, lately, more and more of this is coming in. And of course, uncertainty has a price itself, and that takes time to be reflected in these contracts.
I think very interesting indeed, Chirag. I mean, if we're talking about Europe as a whole, do the same conditions prevail in every kind of national market, or are there differences in terms of the obstacles that you mentioned? So, in some markets, may more be around financing, economics, or regulation. What are the where can you highlight some of the differences that you're seeing in Europe?
Oh yeah, sure, absolutely. So in actually Europe is quite fragmented from a PPA perspective and from the market perspective. It depends on where in the cycle you are of of this system, this process. So for example, Western Europe, Germany started out quite early, and there's a lot of solar. And if everybody is producing solar at the same time, the are prices are low, right? So that's the challenge being faced by Western Europe. But other markets like Poland and Hungary, where there's stable demand, the regulations are good and supportive, the structure is better. There's a grid which is well developed. We're seeing a growing surge of PPA volumes there. However, if you again move towards the Southeast Europe, like Bulgaria, Romania, there we are seeing that the grid is not as developed as Western Europe, but it's getting there. The financing also is not as mature as Western Europe, but there is sprouts and activities of deals, which I think will just scale in the future as we go forward.
You mentioned, Southeast Europe, Romania, Bulgaria, Greece as well. I mean, there's huge potential here, isn't there? I mean, what needs what needs to happen to accelerate growth in those areas, Chirag?
Absolutely. I think grid infrastructure has to become more modern and more developed so that they can have these facilities more and more come up. Regulatory frameworks are still evolving there, and this will take some time to depend upon each jurisdiction, each nationality, how they play their part. That takes a bit of time. Financing has to catch up and become more mature. The deals have to be understood well by all parties involved. The maturity of buyers and sellers there is coming up, is growing. So several factors have to fall into the place. It's like a big puzzle, right? Different players have to fill in their different pieces, and all of them have to play their role. And when everybody reaches a certain maturity in this cycle, then I think we'll see more and more deals surging there.
And obviously, you're seeing co-location and hybrid deals as well growing as well. Is that a growing trend?
Yeah, absolutely. But the problem is that it's not a magic wand, and just having that in place cannot solve these several issues which are linked with PPAs. However, co-location, of course, is a trend. We're seeing a surge in that as well. Hybrid deals, getting your batteries connected to where you're producing the power. But the problem again with that is battery is not the magic wand, right? You just can't put in batteries and answer all questions. It can help you get more of the higher priced power towards the later part of the day. But at the moment, it's self-constrained. There's supply constraints. There's a geopolitical global situation where there's a huge a dearth of supply of these raw minerals to produce these batteries, and the value they capture is not what the whole picture really is, what a base load can offer you. So while it's getting there, it will take some time, and it will take some time to mature.
Absolutely, and the markets generally are growing in complexity as well, with in all the different time frames, ancillary services, balancing markets, Maori, Picasso. These are all increasing the complexity of the markets, as I said. But you mentioned volatility in PPA prices, Chirag. What are the main reasons? What's the main reasons behind that? What's driving it, and how are buyers and sellers reacting to that volatility?
Yeah, so, well, by the definition of it, it's a power purchase agreement, PPA, and volatility of PPAs is just a reflection of the underlying market, which is volatility of power prices. I see three drivers driving the volatility of this. First is there's been a surge in the volatility of power prices itself, primarily driven by gas prices and the geopolitical context we are sitting in currently. Second, there's a huge growth in supply of renewables, especially in developed markets, where that itself is becoming a problem, and we're seeing a sort of cannibalization of prices, where if everybody's selling lemonade at 12 p.m., right, prices are going to fall. And more solar, of course, lowers the daytime prices even further. And third, which we I think touched upon a bit earlier, is uncertainty of future prices. The world is just becoming more and more volatile. And there's a price to uncertainty. And because of this, I think European PPAs have shown strong swings because developers and buyers are now pricing in this uncertainty. So buyers are becoming more cautious, and sellers are asking for better terms. This creates volatility. PPA prices move because power markets move.
Yeah, no, absolutely. It's all about the underlying conditions there. And you mentioned uncertainty, and certainly one of the factors driving that is the current energy crisis. We've now threatening to obliterate Iranian civilization. We now have a ceasefire in the Gulf, and there's an energy crisis brewing, which is tied to gas, to fossil fuels. So why? Surely there should be a surge in demand for PPA deals, for looking at securing renewable, clean energy. Why are we not seeing that happening?
Yeah, absolutely. This is where timing matters, right? So, if in the current geopolitical context, of course, fossil fuel prices in the short term have skyrocketed. But if you look at the longer term contracts, if you look at Brent 2027, it's still hovering around $75-$70 range. While it has seen a bump up, it's not really as devastating as the short term market is. I guess probably the overall market knows that this is going to be a V shaped recovery. As of today, Wednesday, when we're talking, we're seeing a ceasefire. But coming back to your question, yeah, solar doesn't capture that average price. PPAs do not capture that average price. So, to give an example, Germany 2027 delivery baseload power is hovering about 90 to 100 megawatt, but solar only is capturing about €40, €45 per megawatt hour. So it's earning less than half of that. That's because solar is being produced when the prices itself is low. We're moving towards a more granular market. It's about the hours when the price is produced. So even during a crisis, PPAs are not being seen how beneficial they are, and that's not being fully captured yet. That's why demand isn't surging as much as it could have, one would intuitively predict, because of rise of fossil fuel prices, because these are a bit separate in terms of when the power is delivered. And that again circles back to the complexity of batteries and joining batteries to these plants to get a bit more of that power out in the later half of the day where power price is a bit higher.
So that's the solution here: getting batteries in and getting them in at scale to deal with, to trying to capture more of the value of the forward curve. Is that what you're saying here, Chirag?
It's a part of that. Well, the complexity is, I don't have a solution.
No.
The one of the ways I think the global market is looking at it, Europe is looking at it, is building more battery capacity, trying to layer out that production volume. The power, how renewables work, it doesn't depend on demand, right? It depends on nature. So it has to follow nature. And as technology, what we can build is technologies like batteries to spread out that power produced across the year. So it is partly a solution, but as you know, the grid is so much more complex than that. There's imbalanced prices, there's peak loads, base loads, all kind of interactions which have to be taken care of. All of this economics has to be modeled in properly by both buyers and sellers. And fascinatingly, buyers are becoming more and more savvy. We're seeing more and more consumers, industries implementing more and more technology into their processes, because handling this stuff again requires expertise. You need the right people, you need right technology. This costs money. More and more complex contracts is more complex to execute. So operationally also it becomes a higher cost, and locking in that knowledge and expertise right now would help companies pave the way for the future.
Fascinating, and Chirag. I think you mentioned volatility, you mentioned uncertainty, the geopolitical situation, the disparity between forward prices and captured prices, negative prices. Are there other factors that are making it harder to get PPA deals done? Is it mainly pricing, risk allocation, or is there something more structural that's holding back those deals being signed off?
No, in my opinion, we're seeing a resurge in PPAs. While 2025 is probably lower compared to 24, but 2026 we're already seen a strong start. I think we're going to see a V-shaped recovery as buyers and sellers become more savvy, as they iron out more of these what-if clauses. I think the complexities and understanding of how these complexities will be managed will get standardized by itself. Market will come to hopefully a sort of master agreement around PPAs that in case of this happens, in case of this happens. If prices go negative, the risk is allocated in so and so ways. Negative pricing is not helping buyers and sellers because the frequency of that happening has now increased as well. So, but once we get to a structure, I think there's a bit of a slowdown because it takes two sides to negotiate a deal, and both sides are trying to understand what to do if this happens. But once they get around that expertise is built, that ecosystem is built, and then it should get more and more standardized as we go in the future.
Excellent, Chirag. Thank you very much for being a guest on the Plugged In podcast.
Hey, thank you. Pleasure to be here. Thank you, Richard.
And to you listeners, thanks for listening to this episode of Plugged In. If you enjoyed this discussion, please like, rate, and follow to make sure you get the latest podcast episodes as soon as we release them every Thursday. We'd also love to read your reviews of the podcast. It helps us to keep up to date with what you, our listeners, think of the podcast and what content you want to receive more of. Finally, you can head to montelnews.com for more news and analysis from our team of journalists across Europe and beyond. See you next time.